Headlines about China dumping US debt sound dramatic, like economic warfare, but the reality is much less sensational. China hasn't suddenly sold off all its US Treasury bonds. Instead, it's been gradually reducing its holdings over the past decade. At its peak in 2013, China held about $1.3 trillion in US debt. By late 2024, that's down to around $760 billion. This isn't a panic move. It's a slow, strategic shift to diversify China's reserves and reduce reliance on the US dollar. While China's holdings have dropped, it's still one of America's largest foreign creditors, though Japan now holds even more. With total US debt over $36 trillion, China's share is just a fraction. The idea that China could crash the US economy overnight is an oversimplification. The market for US debt is vast and resilient, with buyers worldwide. So the real story is about long-term diversification, not sudden disaster. Let's dig into why China holds US debt in the first place. China's huge US debt holdings started with decades of trade. Americans bought Chinese goods sending dollars to China. China needed a safe place to invest those dollars, and US Treasury bonds were the obvious choice: stable, liquid, and backed by the US government. This created a mutually beneficial relationship. The US got a steady buyer for its debt, keeping borrowing costs low, while China earned interest and managed its currency. Buying US debt also kept China's yuan weaker, making its exports more competitive and fueling its economic growth. But this interdependence comes with risks. China's economy is exposed to US policy and dollar fluctuations. That's why China is now slowly selling US bonds and diversifying into other assets like gold and foreign debt. The goal? Greater economic independence and a stronger global role for the yuan. It's not about attacking the US, it's about managing risk. This shift is gradual, not a sudden break. So how does this affect you? China's slow reduction in US debt holdings doesn't spark a crisis, but it does influence your finances. Less demand for US bonds can push interest rates higher, making mortgages and loans more expensive. For example, a small rise in mortgage rates can add tens of thousands in interest over a 30-year loan. Retirement accounts and pension funds which invest in US bonds may see short-term dips in value if bond prices fall. Over time, a weaker dollar from reduced foreign demand can make imports like electronics, cars, and coffee more expensive. These changes are gradual, not sudden shocks. The impact is real, but it's more about slow adjustments than financial earthquakes. Most Americans will feel it through slightly higher borrowing costs and pricier imported goods. It's a ripple, not a tidal wave. But what if China dumped all its US debt at once? Imagine China suddenly selling all its US debt, the nuclear option alarmists warn about. This would flood the market, crash bond prices, and send interest rates soaring. Borrowing would become much more expensive for the US government, businesses, and consumers. Mortgage, credit card, and auto loan rates would spike, squeezing household budgets and potentially triggering a recession. But here's the catch. This move would also devastate China's own finances, slashing the value of its remaining US bonds and hurting its export-driven economy. The result? Mutually assured financial destruction. Both economies are too intertwined for either side to risk such chaos. That's why a sudden dump is extremely unlikely. Instead, China's slow, managed diversification is the logical path. So is US debt still safe? Despite the headlines, the US Treasury market remains the world's most trusted and liquid. The dollar's role as the global reserve currency isn't going away overnight. For every seller like China, there are plenty of buyers: American investors, pension funds, and other countries. Gradual shifts in global finance will continue, but they're not signs of imminent collapse. Staying informed helps you make better financial decisions without falling for panic-driven narratives. A sudden massive sell-off is highly improbable because it would hurt everyone involved. The US financial system is resilient, backed by a dynamic economy and strong institutions. The real story is a slow, evolving relationship, not a looming disaster. By focusing on facts and long-term trends, we can navigate global finance with confidence. The foundation of the US economy and its debt market remains strong.